My name is Marek Szpeczkowski and I'm joined by Ryan Falls. Today we will talk about what happened with the market last month and what are our expectations moving forward. In terms of the scenarios that we look at and the expectations for the next 12 months, we believe that soft landing still remains the base case for us. Just a reminder how we derive these probabilities here. We do a monthly meeting where we discuss a number of macroeconomic papers and issues, and then we all vote to come up with the score. And so far, we have been proven right. We have been in the soft landing camp for the last 18 months. Now, the biggest risk to that view is inflation. Inflation, is something that keeps us awake, and is something that we are looking very closely at every month. We expect inflation to drift lower, allowing central banks to cut rates sometime in the middle of this year. One thing to note is the short-term inflation, and this is in particular in the US. That is the component that is still very high and keeps inflation above the Fed's target. Here I'm showing you two charts. On the left-hand side, you can see that if you look at the core CPI, the big component is that light blue line. That is the rent and owner's equivalent rent. That measure is still very high. But to give you an idea of what it is, it's actually fascinating because most people think shelter as such is rents. But this is really a component which is derived from the survey. So every month there is a service sent out to homeowners asking them the question, if someone were to rent your house today, how much do you think it would rent for monthly? So that's not necessarily a reflection of real rents. But what we can see on the right-hand side is that that measure tracks the new tenants rental index very closely. So if we just advance that, the real rents by 10 months, what you see here on the right-hand side is that the owner's equivalent should follow. And as a result, the inflation, in particular in the US, should come back to the range that allows central banks to cut. One thing we've discussed before was the broadening of the rally. So last year was all about a couple of names that have rallied a lot and the rest of the market really not doing a lot. What we see recently is that the rally is broadening. And this is our expectation moving forward, as we would expect the other names to catch up to the market recovery. Just pass on to Ryan to talk about funds now.
Yeah, thanks, Marek. I'll quickly take you through the Mint Diversified Income Fund first. So asset class performance was somewhat mixed in February, and this is as a result of equity and bond markets somewhat diverging. So the total fund return was minus 0.2%. That's made up of global equities contributing plus 0.3%, so that's the top positive contributor. And then we had Australasian equities negative 0.4%, and was the largest detractor, with fixed income also being slightly negative at minus 0.2%. Drilling into the actual underlying portfolio, within our domestic equities, our top positive contributors for the month were Meridian Energy up 7.8% and Goodman Group up 15.1%. Goodman Group specifically benefited from an index exclusion into the FTSE EPRA Global REIT Index, which meant strong investor interest in the stock. Within our global component, AMD was up 14.8% and Schneider Electric was up 14.7%, and these were both our top two contributors within global equities. AMD benefited in kind from strong risk-on sentiment within the semiconductor sector after launching their Radeon RX 7900 graphics card, and NVIDIA posted huge quarterly results, so it lifted the entire sector. Looking now at the negative contributors for the month, so as bond yields increased, we've seen a negative contribution from fixed income in February. The 5-year swap, as an example, moved up around 21 bips, and this is as a result of New Zealand markets battling with the potential for a rate hike from the RBNZ on the last day of the month when they had their MPC meeting. The RBNZ actually went on hold. Domestically, the tourism holdings was down 11.3%, with the largest detractor. They reported solid half-year results, but they had disappointing guidance for 2024. Within our global equities, Reckitt Benckiser Group was down 12.4%, and this struggled after a poor market update, where they reported a decline in annual revenues, and that was driven by a weak Q4 performance. Turning now to the growth fund, so asset class performance again was mixed, but with a higher component of equities, we've seen the fund return plus 1.8% for the month. And that was made up of global equities returning plus 2% as the top contributor, and Australasian equities was down 0.2%, and fixed income came in flat at 0%. Looking at the positive contributors within global, we had Martin Marietta Materials up 13.6%, and Tapestry Incorporated up 22.5%. Tapestry released strong Q2 earnings with revenue and earnings both in line with expectations, but then also some strong guidance for the future. And that led to a number of analysts raising their price targets as a result. Domestically, Megaport up 13.8% continues very strong run from January, and this is just announcing their strong half-year results during the month of February. Turning to negative contributors within global equities, Charter Communications was down 20.7%, and that lost ground after reporting Q4 earnings, which had lower earnings than market expectations, and also then looking into the numbers, they had a decline in the number of internet users over the last quarter of 2023. And then within Australasian equities, CSL was down 5.1%, and that was our most negative contributor. This was actually despite the release of good half-year results in February, but it was somewhat overshadowed by the news of a failed drug trial of one of their heart attack medications.
Thank you for listening. If you have any questions, please send them to info@mintasset.co.nz.